This is our accounting process example, and so far we've journalized entries, or in other words, translated English language sentences into debit-credit transactions. We have posted those transactions into T accounts for our ledger, and what we're going to do now is to find the balances in each of these accounts and then create the beautiful financial statements from that information. So if I get a pen, I can total up the debit side of my cash and my credit side of my cash, and I find that my cash balance is $17,600. And it's a debit balance because the debit side has more numbers possible than the credit side. Accounts receivable has a $2,000 debit. Land has a debit of $12,000, credit of $6,000, so it nets to a debit of $6,000. Notes payable, $10,000 credit, which makes perfect sense because liability accounts are increased by credits, like accounts payable, has a credit balance of 3. Common stock also should have a credit balance, whereas dividends will always have a debit balance. Service revenue, $8,000 credit balance. Oh my, look at that number. Expenses always increase by debits, so it has a $6,000 debit balance, and the gain, which is a revenue account, has a credit balance of $1,000. So do you remember which financial statement we do first? You're right, it's the income statement. So we're going to do the income statement first, and we have revenue of $8,000 and $1,000. So our revenue comes to a total of $9,000. Our expenses were $6,000. So our net income is $3,000. And the reason we do the income statement first is I need this number to find ending retained earnings. Now, since this is a brand new company, that means the balance sheet at the beginning of the year had nothing in it. So during the year, when we began operations, we earned or sold and matched those sales with their expenses and came out with a net income of $3,000. Now, net income is reduced by any dividends paid. And notice we had dividends of $400. So to find out how much of the earnings were retained or kept in the business, it's the difference between the net income for the first year and the dividends paid, or $2,600. And so that $2,600 ending balance in retained earnings flows to the balance sheet. Now, contributed capital, since it was a brand new company, it wasn't in existence the beginning of the year and only came into existence when we sold stock for the very first time in the IPO, or initial public offering. And notice that was for $10,000. So stock issuance was $10,000. So the ending balance for common stock and contributed capital is $10,000. So total shareholders' equity would be the sum of those two as of the last day of the year of $12,600. Well, let's see what else we have as far as our account balances. So we have current liabilities of $3,000 and long-term liabilities of $10,000. $3,000 current, which was accounts payable, and long-term liabilities, the notes payable, was $10,000. I think I wrote those down right. Yes. So total liabilities plus shareholders' equity comes to a total of $25,600. So assets should also come to $25,600, because remember, the balance sheet balances as this snapshot of the financial health at the last day of the year. Well, let's make sure. Cash is a current asset of $17,600. We have another current asset of $2,000. So $17,600 for cash. And other current assets were $2,000. We also had land, which is a long-term asset, of $6,000. So if I add $17,600 plus $2,000 plus $6,000, guess what? We also get $25,600. Well, the last statement we're going to do is the statement of cash flows. And the statement of cash flows ends the year with cash balance of $17,600. At the beginning of the year, since the company was not in existence, cash was $0. So during the year, cash changed or increased $17,600. Well, let's see how much of that was due to day-to-day operations, in other words, changes in current assets, current liabilities, or the income statement. And looking at the cash account, I see that I have an operating of $6,000 and an operating out of $3,000. So the difference, $6,000 minus $3,000, is $3,000. So cash inflows from operating activities of $3,000. For investing, those are changes in non-current assets. I see that I had an investing of $10,000, and I also, oops, no, that's not right. That was number 1. That's not investing. How about $7,000 down here in number 6? And I also had an investing outflow from transaction 4 of 2. So $7,000 in versus $2,000 out is a net difference of $5,000. So cash from investing activities is $5,000, or changes in non-current assets. Finally, looking at financing, I see that financing was that number 1 where we sold stock of $10,000. So cash came in of $10,000 for financing. And then in number 5, we paid dividends of $400. So $10,000 minus $400 is $9,600. So we had a cash inflow of $9,600 from financing activities, or changes in long-term liabilities and shareholders' equity accounts. And if I total that up, guess what? We get the change of cash of $17,600. So here's how we have the interplay of building the financial statements. Remember, it's always the income statement first, statement of shareholders' equity second, balance sheet third, and finally the cash flow statement. And those are their interrelationships as well.